Welcome to this explainer, everyone. Today, we're literally putting on our detective hats. If you've ever stared at the stock market and just felt totally overwhelmed by the sheer avalanche of data, the flashing numbers, the endless news, well, you are exactly in the right place. Our goal today is to completely demystify market tracking. We're going to cut through that daily noise and pull out the actionable clues, giving you a crystal clear framework to understand exactly what is driving your investments. So we're going to kick things off with a bit of a riddle. How can you predict today's market just by looking at yesterday? I know, it sounds like some kind of magic trick, right? But for the Indian stock market, the secret actually starts overseas, literally hours before the opening bell even rings in Mumbai. Here's our macro to micro roadmap for today. First, reading global market clues. Then, tracking the big money. Third, commodities and currency impacts. Fourth, stock-specific news matters. Fifth, beginner stock strategy playbook. And finally, long-term safe havens. Okay, let's dive right into this. Section 1, reading global market clues. All right, so before you even think about looking at local Indian indices, you really need to check out what happened on the world stage. See, a trader's day actually starts the night before. You've got to keep an eye on U.S. indices like the Dow Jones and the NASDAQ. Then, right before the Indian market opens at 9:15 a.m., you want to check the SGX Nifty or SGX futures. This is a massive clue. It basically tells you if the Indian market is going to experience a sudden gap up or gap down right at the open. But hey, the global influence doesn't just stop in the morning. Fast forward to around 1:30 p.m. You might see a stock that's been totally flat on mornings suddenly make a massive run. Why? Because the European market's just opened. A positive opening over there can send a sudden jolt of optimism right into the Indian market. And of course, a negative open can drag it down. And this is where the US ADR, or American Depository Receipt, comes into play. If you want to know what's going to happen to a specific major Indian stock, this is basically your crystal ball. Take Infosys, for example. Sure, it's listed in India, but it's also listed in the US as an INF ADR. There are others too, like SBI or HDFC ADRs. By checking how that exact ADR performed in the US market on Monday night, you get a really strong approximate idea of whether that same stock will fall or gap up when the Indian market opens on Tuesday. Honestly, it's an incredible tool. Section 2, tracking the big money. So once the global stage is set, we need to bring it home and look at domestic market sentiment. First up, we have the FIIs, which stands for Foreign Institutional Investors. These are your large-scale foreign entities pumping serious cash into the country. They buy up huge, market-moving quantities of Indian stocks. So when that FII data drops, you absolutely want to be paying attention. Then, on the flip side of that coin, we have the DIIs, or Domestic Institutional Investors. Think of the massive Indian mutual fund companies, or giants like LIC. These guys are your heavy-hitting domestic buyers. Now, the absolutely crucial point here is how these two giants interact. You're basically comparing institutional sentiment. If you look at the daily investment data and see that FIIs are buying more than DIIs are selling, well, that generally points to a positive trend in the overall market, lifting indices like the Nifty 50. But conversely, if FIIs are dumping shares in massive quantities, way more than DIIs are buying, that heavy selling pressure is a clear signal of a negative trend. When big money moves, they dictate the momentum. Plain and simple. Section 3, commodities and currency impacts. Zooming in a bit further, we can really see the domino effect that global prices have on specific sectors. And this brilliantly illustrates exactly why tracking things like Brent crude or the dollar actually matters to your specific portfolio. Look at these contrasting fortunes. If the price of gold goes up, jewelry companies actually take a hit and take a loss. But gold finance companies like Muthu, they make a profit. And what about crude oil? If crude prices surge, industries that use it as a raw material, think chemicals and paints, they're going to see their margins squeezed and suffer a loss. Then there's the US dollar. If the dollar strengthens to, say, 83.6 rupees, Indian importers lose out. But Indian companies that trade in foreign currencies, specifically the IT and pharma sectors, they make a profit because their foreign earnings suddenly translate to a lot more rupees. It's like a giant puzzle. Everything is connected. Section 4, stock-specific news matters. Now, macro data like oil and currency, that's really only half the battle. You also have to follow the specific narratives of individual companies. And to do this properly, you need to be reading quality financial papers like Business Standard or the Economic Times. Why? Well, let's walk through a hypothetical life cycle of some corporate news. Imagine you're heavily invested in SBI Bank. Step 1, a person or a massive company takes a huge loan from them. Step 2, news breaks in the morning paper that this borrower has defaulted. Step 3, SBI finds out, the broader market reacts, and there is a very, very high chance that the stock plunges the very next day. Tracking the 52-week highs and lows is great, sure, but knowing exactly why a stock is moving, that requires actually reading the news. And here's another prime example of the kind of news you really want to catch, a share buyback. Let's say a fundamentally strong company is currently trading at 1,500 rupees. Suddenly, they announce a share buyback at 1,650. What happens next? Well, depending on the type of buyback, there's a decent chance that the current stock price will get pulled up, rising from that 1,500 mark to meet that 1,650 target, or maybe even higher. Catching that kind of news early is just a massive advantage for you. Section 5, Beginner's Stock Strategy Playbook. Okay, now that we've decoded all these market clues, let's translate this tracking into some actionable directives for your portfolio, especially if you're a beginner. First up, large caps. It is incredibly common for beginners to be told to just jump right into large cap mutual funds, but actually, you might want to skip them. They often yield somewhat lower returns, usually sitting around 12 to 15%. Instead, a much smarter play is to opportunistically accumulate fundamentally strong large cap stocks directly when they hit good prices. You can reap a lot more benefit buying the stocks directly than settling for the mutual fund's lower average returns. And a huge reason for that is commissions. Regularly managed funds can have hefty margin charges that, depending on the structure, can eat away massive chunks of your wealth over time. We're talking sometimes reaching an unbelievable 8% in total commission costs. Compare that directly to nifty index funds. Those have absolutely tiny margin charges of just 0.1% to 0.2%. To put that into perspective, those savings are an absolute game changer for your long-term wealth. So let's summarize this beginner action plan. If you're feeling bullish on a specific sector like banking or IT, don't try to pick just one winning stock. Invest sectorally using nifty sectoral index funds like the Nifty IT, Nifty Bank, or Nifty Pharma. Now, if you want to take on just a bit more risk for potentially higher growth, use small cap mutual funds. But crucially, and guys, this is a strict rule for beginners, avoid buying direct small cap stocks or direct penny stocks. Leave direct small cap picking completely alone until you reach an advanced, or at least, an okay-ish level of market experience. Section 6, Long-Term Safe Havens. We've talked a lot about trading and index funds today, but what about the ultimate sleep-at-night investments? Well, this brings us to the National Pension Scheme, or NPS. This is just a brilliant instrument for the long term, and it's vastly better than doing nothing at all. It offers Tier 1 and Tier 2 accounts, and what makes it so insanely attractive is the incredibly low commission charges, which hover right around just 0.1% for index funds. It's a super efficient, low-fee way to park your money. And then, of course, we have the Public Provident Fund, or PPF, which is currently boasting a very attractive interest rate of 7.1%. Let's quickly look at the specific terms of the PPF, because it really does reward patience. Yes, it has a pretty strict 15-year lock-in period, but the benefits at the end are massive. It is completely tax-free at the time of maturity, and your contributions are claimable under Section 80C. So for a patient, long-term investor, it is a total powerhouse of tax benefits and guaranteed returns. Which leaves us with this final thought to ponder today. Are you just reacting to market noise, or are you actually reading the market's clues? By tracking global indices, following the big institutional money, understanding the domino effect of commodities, and choosing smart, low-fee index and pension funds, you stop being just a passive spectator. You become a true market detective. Thank you so much for joining me on this explainer. I really encourage you to take these frameworks and start observing how they actually play out in tomorrow's market. Keep learning, stay curious, and I'll see you next time.